Welcome, everyone, and thanks for joining us at this year's mid-year M&A update. We've got quite the panel here for you today. In fact, I have no way to prove this, but I suspect that between Spencer and Heidi and Brittany, the group we have here today has probably looked at more potential transactions in the last 12 months than about any group we could assemble. And so you really have individuals that have a front row ticket at the M&A games shared information today with you on what's happening and what you need to be thinking about. And probably the best way to kick it off is maybe each of us kind of introduce ourselves and why we're here on the panel today. Say a word, if you will, or two about your firm and your experience in this space. I can kick us off. I'm Dan Cook, principal at TrueNorth. Depending how you measure, we're somewhere between the first and fifth largest transportation insurance broker in the U.S. I tend to lead teams in the M&A diligence and integration space, captive feasibility, captive management, and all things strategic risk financing. Been doing this for 34 years, I think, this year. The last 10 years as a principal at TrueNorth. And as long as I get to work with great people like Spencer and Heidi and Brittany, hope to do it a lot longer. So, Spencer, if you don't mind, tell us a little about Tenney Group and yourself.
Well, thank you, Dan, and thanks for moderating this panel. Like Dan said, I'm Spencer Tenney, CEO of the Tenney Group. We're an industry specialized merger and acquisition advisory firm that's been dedicated to transportation and logistics since 1973. And it's our great pleasure to fill an important void in this space, which is serving business owners that are in that 20 to 300 million in annual revenue spot all across the T&L spectrum, and primarily working with those that are trying to exit and removing as many pitfalls as possible from that process so that they can exit on their terms.
Brittany, how about you go next?
Yeah, so I work at KSM. We're a CPA firm that has several different services with due diligence team internally as well. And I specifically serve in the tax consulting and compliance services, partner at KSM. Been here 15 years, spent a majority of my time in the transportation industry, which is one of our largest three industry focuses of the firm. And so glad to be here today.
Welcome. And last but certainly not least, Heidi.
Yeah, my name is Heidi Hornung-Scherr. I'm president of Scudder Law Firm, and like TrueNorth and Tenney and KSM, we also specialize in the transportation logistics industry. And we further specialize by just focusing on business transactions. And I have had, been able to work with all of the firms that are on this call, and I think there'll be good insights during the call. And I'm also work closely with the NAFC, and the ATA sponsors this group that's set up for finance counsel professionals. And we would encourage people to participate in the upcoming conference and learn more about M&A in the space as well.
Yeah, thanks for mentioning NAFC, Heidi. It's looking like we're going to have a great turnout at the event here in June, and look forward to seeing many people that are interested in M&A activity there. To kick it off, it's probably good to just get kind of set the landscape if we can. Spencer, I'd probably start with you on this one, but in the first 5 or 6 months of 24, how has M&A activity been different than in 23 or perhaps even 22 from your perspective?
I think what we're seeing is significant changes. There were many folks that expected to exit in 2022, but understandably chose not to exit because the conditions would have been quite punitive to them based on the freight market and the interest rate market. And then folks that did want to exit and try to get a deal done, found it very difficult to get alignment on valuation and structure with buyers. So we're starting to see that level off and to normalize and to have a much more stable environment for deals to take place. And so some evidence of that is just a significant surge of sellers that either because of fatigue or because they're seeing that we effectively have hit the bottom on the freight market, they've returned to the market. And then they're being greeted by a group of buyers that have needed to grow, that have had a mandate to grow and need to put capital to work. And so that doesn't mean that they're throwing money around, but I think what we're seeing is parties coming together that need to transact. They're being very thoughtful about valuation. They're using structure to help protect one another, to help get alignment on deal structure and valuation. And I think that as the year continues, we're going to see a significant uptick in overall activity. But I think the primary characteristic, these are going to be smaller, more niche deals. We're still not ready for, large transformational platform type transactions, much fewer quantity of those.
Makes sense. It's funny that you say that, how we're having a hard time getting value, and we have to recognize an unusual freight market that we existed in 23 when trying to think about a value in 24. If I think back to 23 when I asked that question, we were having to compare what we thought was going to be a normal freight market to the COVID market and make adjustments relative to valuation. So while the way we're adjusting today is different, the challenge is the same in many regards. And so we recognize it's a difficult time. You mentioned interest rates. You mentioned freight rates. Heidi, there are segments, though, I would assume, where deals are getting done. Are there areas that there's more activity than others?
Yeah, I do think so. I think that there are some areas that there's just hard to find a deal because you got to get a matchup of a buyer and seller, and the seller often won't have good performance. But LTL continues to have deals. Some of the most acquisitive companies in the industries like Knight-Swift and TFI are, continuing to, announce publicly that they're trying to find LTL acquisitions. There are some specialized truckload deals that are getting done. We just closed one in the last week, very specialized. It was an overseas buyer. I think, and then when Spencer talked about specialized and niche, I think that will be that way for a while. From what I hear, the freight market may not turn around until early next year. And so, but it's a good time for sellers to get ready because it does take a while to get ready for a transaction. But I think the number of transactions, you just really got to find a sweet spot between a buyer and a seller, and you may have to look a little bit to some non-traditional places to find somebody that makes sense.
Yeah, makes sense. One of the things I like about this panel is none of you have chosen to just work in big deals or just do little transactions. There's a lot of exposure here to deals of all sizes and all types. And so this is probably a fair question for Brittany as well. Are there modes of transportation, Brittany, that you're seeing where there has been recently more deal activity, or you anticipate there to be kind of an uptick ahead of other areas of the industry?
Yeah, I mean, we've said it, everybody's said it so far. The niche modes seem to be most attractive. Dedicated, anyone that has dedicated contracts that are strong, not tied to the spot rate, are more attractive right now too. Yeah.
Kind of piggyback on that, Heidi, I'd ask you, because I know you've got some exposure here. We've seen more public company mergers in transportation over the last couple years than we had in prior years. Can you speak to that a little bit? Why you think that is, and what you expect for the future?
Yeah, I mean, I think it's tough for private companies, but it's tough for public companies too. And when you're performing in the limelight and have to announce your results quarterly, you're under a lot of scrutiny. And if you're, have a bad freight market or in a turnaround or, various things you're trying to do to improve your performance, the public knows about that, and then it becomes reflected in your stock price. So over the last couple years, the Patriot acquisition by United Petroleum, the Dasky acquisition by TFI, um, the DB Schenker acquisition of USA Truck. You know, the DB Schenker probably was one where that they were using that as a way to get into the market. But for the others, there were companies that were either small and it cost a lot to be a public company, or they had performance issues. And so it was a good time for those stockholders to get, a payout through the merger. And, I think that will continue. But I think we'll also see a pickup in private deals as the market turns. And I completely agree with Brittany on the dedicated, if you're a commoditized over the road trucking company, it's harder to get something done. It's not impossible, but you got to make sure you present yourself in a way that attracts some interest. But I do think that the public company transactions will continue, both on the merger side with go privates and then the large public companies acquiring companies, just because they have a mandate to grow. That's what public investors expect.
Yeah. You mentioned the financial reporting of public companies, and that you know makes me think about something. I probably posed this at Brittany. One of the issues I've often heard Spencer and his team talk about trying to get a deal done or establish a value is poor quality of financials or financial presentation of a potential seller. And we often hear conversation about during bad times or slow times like this freight economy, how businesses work on their own issues, try to become better so that when the market returns, they're ready. Have two-part question here. Have you seen transportation companies start to acknowledge, and particularly those that don't require audited financials, that it's important that they have better financials? And have you seen them use this opportunity to work on their financial presentation or not?
Yeah, it's hard because a lot of them are required to have audits. I mean, very few aren't. So I think financials are being looked at, but I would say not to skirt the financial question, but we've seen a lot more talk to consultants about their operations and what can we do to strengthen our operations, right? To prepare, to put us in a better situation in 5 to 6 months if we're thinking about selling. And I think looking at it more that route, which in a way, when you're looking at your operations, you're looking at your financials, right? And digging into the numbers and cleaning them up some. But I think trying to do more freight optimization and strengthening their operations to make them be better, look better, and to be able to go to the market, in 5 to 6, 7 months is what we're seeing more of.
Yeah, as you talk about operations, I really think about some of the strategics that we work with and that focus on operations and operational activities of targets. And Spencer, I'd ask you, how do you think the strategics today are viewing and getting ready to use growth through acquisition versus maybe in the past? What's their view on M&A based growth?
Well, I think this, the inflationary effects on our industry, they just won't quit. And I think that what that's creating is a whole new generation of acquirers who really didn't want to or need to grow via acquisition in the past, but now it's very difficult to have a sustainable company and not have acquisitions integrated in some way to your strategic plan over the long term. And so I think the main thing is we're seeing a lot of people get in the game, and I think that's very healthy. In response to that, there's also, because of the constraints and the challenges in the market, you're seeing just a very high level of discipline from acquirers. So yeah, there's companies that on first glance, like they don't satisfy the basic things that buyers need, both in terms of speed, that they can produce financial information, and the quality of that information. And there's also a lot of different things operationally, as Brittany mentioned, that they're just not ready to be valued in a way that they're going to appreciate. And a lot of that's because they have, excessive overhead. They have legacy employees. They have a lot of things that this, there's no appetite for in a market that is so compressed right now when it comes to margins. And so I think that the good news is when you have this type of tension in the market, it kind of eliminates all the potential excuses to not advance the type of initiatives that create value and change. And so I'm excited to see a lot of companies who have thought about doing certain things for several years, are now doing that out of necessity. So they're going to groups like KSM to figure out how to get where they need to be, how to get their financials in order, and they're going to consultants to figure out how to do this. They're coming to us and they're figuring out, well, if I don't like what I'm valued today, like how do I get to where I want to be? I think those are all positive things, because the reality is any like a educated buyer is likely looking at 4 to 8 different deals at any given time. And I think that that's what I want to really impress upon business owners in this space, is that the competition is high, and you have to be able to compete in the way that you present, in the way that you're managing your business, if you want to be considered at all, but more especially be considered and be valued at a premium level. And so that's I think that's the opportunity for folks right now.
Yeah, I mean, in that regard, Heidi, if you have a client who's preparing for an equity event, they're preparing to exit, what are some of the key things that you see they're doing in preparation for that pending event?
Yeah, I think that you can't really underestimate how much time you need to get ready. And it's for sure not a month or two. And if you really want to be ready and capitalize on valuation and eliminate all of the things that could come up, you need months of preparation. And when I was preparing for this, I was thinking back over the deals and the most common issues that came up in diligence that either stalled the deal or terminated the deal or caused a um, renegotiation of economics. And by far, the thing that's at the top of the list for me, anyway, has been claims. And Dan, maybe you can talk to that a little bit, but it is, you just need to be on top of your claims. You need to get them settled. You need to have, proper accruals for those, especially the larger buyers, including if they're public, they're going to be doing a very deep scrub of those. And so, and unfortunately, we're in an industry where we have large uh, accident claims. And so you can't prevent those from coming up. I mean, other than the normal safety things you're doing. But when they do come up, being able to address them quickly, having a good team of advisors. I know TrueNorth has a lot of expertise in helping companies, look at their claims and how they're managing them and what they look like in M&A. But that comes up a lot. We've had a couple more recent deals where tech issues have come up, one in which there was a cyber attack with all of the information taken. And I do think also with more focus on technology in the industry. It used to be the technology focus was what operating system do I have and what operating system do you have and how are we going to get those together? That's still very important, but there is a lot more focus on the tech part, and I think that's going to grow. For instance, we're seeing some companies start to use AI, and I think then that may be something that in diligence people are looking at, but going back to claims, maybe Dan, you can talk about that, because when I look back over deals, that's something that's highly prevalent in either extending the diligence period or causing an issue that could impact valuation.
Yeah, and I guess what I would say here is, rather than try to solve the claims issue, I would expand it. I think when you talk about claims and you talk about these large verdicts, you're talking about auto predominantly. But these claims conversations relative to diligence are occurring all across the spectrum. There's a big uptick in theft claims, cargo claims occurring right now. Medical costs are going through the roof, and most acquirers are self-insured on their health care. And there's a lot of work that can be done from a risk management and a claims management standpoint around the self-insured health plan. And large claimants are going to impact future costs for the acquirer. Workers' comp issues. Workers' comp premiums are at an all-time low in my career. So it doesn't take much of a claim to upset the apple cart when it comes to loss ratios. And so diligence around all claims activities has become, it keeps coming up. And claims activity also drive the need for collateral to support the risk financing programs of both the acquirer and the legacy entity. So you're deploying capital. If you have any sort of a deductible self-insured retention or captive structure, your claims activities pulling capital, working capital away from the business. So there's just a lot of ramifications to making sure that you're addressing that issue. I dive in one other way on this preparation issue, and that's for you, Brittany. It's from a tax perspective. What are potential sellers doing maybe in the year or two leading up to their equity event to prepare?
Yeah, so the big thing we're talking about now is estate planning. The lifetime exemption is set to decrease significantly at the end of 2025. And so if you're looking to potentially sell in the next year or two, thinking about, is there opportunity now before you sell? If you're planning on doing it, it's probably more beneficial to maybe gift stock in the company before you sell rather than waiting to get the cash and giving the cash. There's discounts that can be utilized potentially in valuations of selling or gifting stock. And so talking about those conversations now and getting input from your advisor and seeing what options you have before the transaction, if that's in your in the forefront of your mind, as to sell and then gift. Those are the conversations that we want to have before you sell it, to know your options. And ultimately it may be that you sell and then there's estate planning, but better to have the conversations beforehand than after the fact. So those are some big things that we're talking about now.
Makes sense. Heidi, you had mentioned AI. I'm not sure just in what context, but are you seeing AI and other technology specifically impacting transactions? How would that be?
Yeah, so we've seen some brokers starting to use AI in answering questions, from booking loads. Also on the carrier side, we have carriers that are starting to use that in their HR recruiting and stuff. It's something definitely need to be thinking about. From a legal perspective, we see AI being used a lot in transaction documents. There are some people out there that are starting to use that in diligence to more quickly search for documents and spot issues. I think it's just starting to take off, but it does create some issues with privacy. If you're doing diligence, you need to understand if the privacy laws are still being complied with. Um, it's also some questions about the validity of the information that you're getting out of AI. And so I think it's just, just beginning to start, but I do think it's going to have an impact on M&A activities and also just in our industry as how companies operate their business.
Yeah, I know it is in ours. We're using AI in several applications, everything from contract to view to our data science team, and it only makes sense that it would affect the transactions in the transportation space as well. One kind of an elephant in the room that we haven't talked about yet is equipment values. Brittany, how How are you seeing depressed equipment values impact transactions?
Yeah, unfortunately, a lot of companies are upside down in the equipment. Purchased high, 2, 3 years ago, still have that leverage on their books. And now, when they go to sell, looking at it, by the time they pay off the debt they still have and pay their taxes, they're upside down. And so it's making it hard to get deals done. Also, um, buyers are looking more at equipment. It was really EBITDA driven a couple years ago. Um, but now that EBITDAs are down, really, looking into equipment and those values are down. So it's making it harder for deals to get done with the drop in the equipment prices.
Makes sense. I guess, Spencer, I'd like you to, can you do more with that? I mean, you don't have to pile on, but how is
Yeah. No,
affecting?
well, with the reduced equipment values, you have the reduced advance rates. It just kind of is a ripple effect in terms of our abilities. Um, it affects the instruments from which we can use to um, have a meeting of the minds, and so I think that what we're seeing now is a much more educated seller, and also buyer, and the realities are like both the buyer and the seller want that equipment to be as valuable as possible because it helps um, increase the borrowing capacity and to get the deal done. So when it's not there, it's requiring the buyers and sellers to bridge that gap through structure, which could involve some seller notes or some earnouts or roll forward equity. There could be a whole host of different things that they're doing. But I think um, what I see as a positive thing right now is just both buyers and sellers recognizing that this is an environment that you can still achieve your goals, but it's going to require much more collaboration together to get there than it did in the last couple of years for sure.
All right, and Heidi or anyone, do buyers want the equipment today? I mean, I've certainly heard situations where they're just not as interested as they used to be, or they have a very specific spec that they've moved to. Are you seeing that be an issue where they just don't want the equipment?
Um, I think that is something you see sometimes, but there is still a little bit of difficulty in getting new equipment. And I think that if it's a transaction of size, there's just no way to not take the equipment because of the transition issues it creates, unless you have a lot of equipment on the fence. And there are some big carriers that have a lot of parked equipment. But because we have seen more specialized deals where that equipment is sometimes very difficult to get and a long lead time, we still see a lot of value being placed on the equipment. Um, I'm going to date myself a little bit, but in the industry, when there were acquisitions in the mid to late 90s, there were dozens of deals that were based upon the value of the equipment plus a value of the driver. And we've seen actually a few deals that are similar to that recently because of the fall off in performance. Maybe there's a target that's a good fit with you, that as far as, expanding your geographic reach with current customers, getting new customers, obviously getting new drivers, but they're still looking at the equipment value, and obviously the driver base. And I was actually wondering, Spencer, do you recommend to your clients that they often get a recent equipment appraisal, or does that come up very often?
It definitely comes up in a market like this where the earnings are compressed and as a multiple of EBITDA, maybe it might be less than the value of the actual assets themselves, which is very common. Even, I mean, depending on the size of the business, that can become common in any market. So if we know that the primary driver of the valuation methodology is going to be the equipment, then yeah, we will definitely want to lead with that to help expedite the process and to help, because that's it's a depreciating asset. So we want to try to get the deal done as fast as possible, knowing that the primary driver is the equipment, which is depreciating. So we'll get that appraisal on the front end and try to lead the buyer towards a very straightforward type valuation methodology so that they can make an offer and get it closed.
Yeah, the whole equipment conversation, I've had several of these conversations over the last few weeks with major lenders, major financiers of equipment, and obviously they're all extremely aware that they're upside down on a lot of their lending activities on the fleet they support, and they don't want the equipment either, and hence we have a capacity issue. There's certainly people that are not within their covenants that are not being foreclosed on right now, because the lenders don't want to do that to the business first and foremost, or to the families involved. They also don't want the assets. The other side of that coin, that in some of these calls or conversations that we've had over the years, is the driver capacity. And I'm curious, Heidi, how do you see today in this environment the driver population impacting deals? Our fleets, there were transactions not that long ago where it was almost purely to get drivers that you saw certain deals get done. What are you seeing today?
Yeah, generally we're seeing lower driver turnover, just because of the industry dynamics. Although there's still people moving to kind of try to drivers still moving to move up the chain to a better position. But I think buyers are maybe still concerned about drivers, but maybe a little less so because they're having an easier time seating equipment. But I do think also the driver turnover at the target is an indication of what's happening at the company. So for instance, if you internally have seen your driver turnover, for instance, go from 110 to 70%, but you're looking at a target where their driver turnover is flat or up, it could be an indication of some other issue there. And that has been common because I think in general, the driver turnover has been improving. I've heard the driver classes have been very good in size as far as the incoming people. Student classes have been good. And so drivers will always be very important in a transaction just because, that's kind of what keeps your assets moving, and keeps the public safe and keeps your claims down when you have good quality drivers. And so I think it will always be a focus, but maybe it's a little bit different dynamics, because I think the market has eased up a little bit.
Yeah, I would tend to agree. The different twist on that is the type of driver. Brittany, I'll ask this of you and Spencer, but maybe I'll start with you, Brittany. Are you seeing a bias one way or the other today, right now, for independent contractor capacity versus company driver capacity within the transaction that you're looking at, or is that much of a factor today?
I haven't seen that be much of a factor today, just because drivers in general, in preparing for this, that was one of my thoughts too, is 2 years ago, I mean, there was significant goodwill paid for drivers and there were transactions happening just to get drivers. And I'm not seeing that today. I mean, yes, they're still important. And they're still involved in the conversation, but it's just, you're not seeing the need or the desire to buy drivers, essentially, where I feel like even 2 years ago that was completely different.
Okay. And Spencer, as you think about deals that you've done recently or that you anticipate are going to happen in the next 12 months, is there more of an appetite for asset-light capacity or company capacity? Is it much of a factor from your seat?
I think it's more the primary driver that kind of supersedes everything is, is it insulated from what's happening in the freight market? Yes or no? And I think that if it's like from a model standpoint, if it's highly dedicated, like a truly dedicated model, that's going to be the primary driver of valuation in the way that they think about it. And to Brittany's point, when everyone went and everyone converted to an independent contractor to try to capitalize on the craziness of 2022. Well, then, like when the spot market adjusted and all of them really, or not all of them, but many came back um, to an employee model, like there just doesn't seem to be as much sensitivity around that. The greater sensitivity is, um, does the target acquisition profile provide us some risk mitigation to the broader things that are happening in the market right now? That's pretty much what we're seeing.
That makes sense. Well, I think maybe the final question that our audience certainly probably interested in is if you would each just tell us when the freight market's going to improve. That would be really helpful. All right. Absent having crystal balls, maybe I will shift though to the topic of our conversation, which is M&A. Maybe I'll start with Brittany, then go to Heidi, and Spencer, have you put a bow on it in detail if you would. But Brittany, how do you see deals evolving? What do you see the second, overall deal volume, structure? Any thoughts from your lens for what the remainder of 24 might look like?
Yeah, I think it will still be slow. The rest of 2024, hopefully maybe picking up towards the end, but I'm just seeing more people focus on preparing, knowing that it's tough and trying to spend this last half of what can we do to get ourselves in a position that, come early 2025, that we'll be able to push us through. And like I said, freight optimization, I feel like is a big thing, trying to button up. And if they have different revenue models too, taking a look at, specifically like brokerage, what can we do there to make that look more attractive as it's been hit versus transportation revenue, and just trying to tighten the financials and operations as best they can to maybe get a better multiple or higher purchase price in 5 to 6 months.
Sure. Heidi, your thoughts on deal structures, volumes, valuations in the second half of the year?
Yeah, in the second half, I do think there'll be some deals get done. I think it'll continue to be specialized, or you're different. Your company is different. For some reason, you've figured out how to do something different and you're performing well. That's a real indication that you have less cyclicality, you have something special going there. And so find that thing that makes you special. Get a team together that can help you advise on that. As far as deal structure, I still think earnouts are going to be prevalent, or deferred payments, and perhaps even longer term earnouts. You may still get your deal done, you may get cash at closing that gives you some comfort and meets your tax needs, but there are deals where there has been sizable amounts put in earnout and not over a year, sometimes over 2 or 3 years. So consider if that's something that you're willing to do, if to still get the deal done. But again, just I think find out what's special about your company, and even if you're not ready and think you're going to be ready in the second half of the year, if you want to do it next year, start preparing. It takes time, and I think that, like I say, having people get advisors to kind of tell you what to do and help you along the way will put you in a better position when you're ready to go to market.
Makes sense. And I guess, Spencer, if you don't mind kind of putting a bow on that, what do you think about structures, values, volume as we move into the second half of the year?
Well, what I would, I'm an optimist. And I'm very encouraged. We have 7 deals under LOI right now. They're going to close by the first week of August. And, and that's after a pretty muted period, we're very encouraged by that. I'm especially bullish on the profiles of companies that kind of satisfy some of the things that Heidi and Brittany have talked about, which is, the specialty brokerage, the really niche things, the dedicated, final mile warehousing. Those are all getting significant attention. Matter of fact, we were just working on from the buy side and got significantly outbid on something that I completely did not anticipate. And so to me, I share that to share, like, if you're one of those profiles that addresses that chief concern of buyers to diversify, then I think there's not only deals can get done, but I think that for those specific profiles, pretty competitive valuations, as I just shared. So I'm excited about that. I think for my charge to pretty much everyone else is, this is the environment probably more than ever. It's just, you got to continue to stay agile and stay educated, because the reality is, we can do a lot of things to enhance the business, but what we can't do is kind of replicate what pain a buyer might be experiencing right now and what they're willing to pay to offset that. So if someone knocks on your door and says that I'm interested in your business, my encouragement is that that's something that you need to explore, because you could work for 2 years and not be able to replicate what it's worth to them in that very moment. And so, like I said, stay agile, stay educated. I think we're headed towards a much, much better environment. It's going to be a little bit bumpy, but certainly the back half of 2024 is the best that we're going to experience, certainly over the last 12 months.
Well, that's the goal of this workshop, right? Or this conversation. You guys have all shared a lot of information that's timely, valuable, relevant, certainly some advice for potential sellers that they can apply in their business over the coming months. I'm bullish too. I know it's a hard period, but I also know for sure there's a lot of pent up anxiety to have an equity event amongst businesses. And there's also a lot of pent up desire to grow via merger and acquisition activity. It's just a matter of when it all releases. And geez, if you got 7 deals that are closed, and it sounds like some of it at least is starting to move. So I hope our audience is able to take a few things away from this. Don't hesitate to reach out to Brittany or Heidi or Spencer if you have a specific question. Not everything's billable. People are happy to share in this group. So, pick up the phone. It's always better to learn from others' tuition payments than to make them yourself. So thank you for your time today, and we look forward to doing this again in the future.